Welcome back to Morning Markets. Technology stocks, of course, have rallied this year, and investor enthusiasm over artificial intelligence is a big reason why. Here's a look at a widely traded technology ETF. It's the Technology Select Sector SPDR ETF. It's up 38% so far this year. Can the run continue, however? Let's talk about it with two experts. We're joined now by Doug Clinton. He's co-founder and partner at Deepwater Asset Management, and Hatem Dhiab. He's managing partner at Gerber Kawasaki Wealth and Investment. Gentlemen, thank you very much for joining us to talk about something that's really front and center for investors around the world. Doug, let's start with you. This AI-driven rally that we've seen quite recently this year really got kicked into overdrive by that guidance issued by NVIDIA not so long ago. How does this this rally compare to other tech asset rallies that we've seen over history?
I think it compares well. I mean, if you look back, you can go back even to railroads, you can go back to television, and the market tends to do this when we see some paradigm shift kind of technology, which we believe AI is. I mean, we think AI will probably actually be bigger and more impactful than the market thinks over the long term, if you can believe that. But the market is very bullish on it, and I think that the challenge we may run into is that over the shorter to medium term, we've priced a lot into many of these AI assets, and eventually you have to have revenues and earnings that justify the bid up in those prices. And I think eventually we'll get to that stage. The thing that we're uncertain about is euphoria has no expiration date, and it could last a long time. We could see asset prices that relate to AI keep going higher, but I think it's best served for investors to be cognizant of valuation right now as people get more and more excited about the technology.
Hatem, a similar question to you. How should investors be thinking about this excitement over AI?
I totally agree with Doug. I think AI is going to create such a tremendous productivity gains in so many different sectors. And with the advent of ChatGPT and Bard, we actually can see that. It's a killer app that really allowed us to see what the potential is. And as a result, a lot of the hyperscaler, a lot of the companies that provide the picks and shovels like NVIDIA are going to really benefit tremendously from it in the short term. In the long term, I think that's going to go to other businesses and companies and so forth. Someone told me the other day, AI is basically the pixie dust of the investment world right now, and I love that term, actually.
Doug, what do you think of NVIDIA in particular, which seems to be the flagship AI stock?
Incredible company, obvious winner, and to your point earlier, I mean, the guidance was, I think, part and parcel of what they are building. It's proof that what they have created with their accelerated compute platform, they are the company to beat in AI broadly. I think they dominate compute. I think there will eventually be other solutions, hopefully, that make AI more cost efficient. But the challenge for us with NVIDIA, and it was a stock that we actually held in our index, which powers the innovator Deepwater Frontier Tech ETF. We held it earlier this year. We have market cap constraints on that fund, so we did exit it earlier this year. And I feel good about that decision. I think that we are seeing prices now for NVIDIA that, again, demand a pretty fantastic future, even though we think the future will be very fantastic. To think that it can exceed what's sort of priced into NVIDIA would have to make you very, very bullish on what AI ultimately does.
Hatem, what about Alphabet and Google, the company that has for so long really defined the online world?
Yeah, Google, arguably people say that Google is a bit late to the party, but I will argue against that. They have over 10,000 people working just in AI, and I think Google actually really started the category. If you kind of compare ChatGPT and Bard, I think actually Bard is much better. But more importantly, Google has the largest data set that you can find in any other company. They have YouTube, they have a lot of our networking data, a lot of the search data, all of which can be used to create tremendous LLMs and really provide some amazing intelligence for them with how to best use AI. So I think people should really look at Google, and this should be part of the AI portfolio.
Doug, how do you value these stocks, and are they at this point overvalued?
I would say generally the way we think about valuation is we want to look at free cash flow generation. So we think about, in a simplistic way, what are sort of the free cash flow margins we think are reasonable to expect for a company 3 to 4 years out from today. So we're really focused on that kind of 2 to 4 year period. And then we apply what we think is a reasonable multiple, which we back into a free cash flow yield, which, generally that means we're comfortable paying, 15 to 25 times future free cash flows if we think it's a business that has persistent growth qualities, meaning that even beyond that 3 to 4 year period, the company can continue to grow revenue in the 10 to 15% range for several years, just like we saw the leadership in big tech do, throughout much of the 2000s. So in terms of valuation, I think it's sensible to really look at free cash flows, not just revenues, and be sensible, again, with the multiple that you're willing to pay for those cash flows in the future.
Hatem, same question to you. Valuations of the stocks that have taken off so far, and how do you value them?
Yeah, we look at growth stocks a little bit differently. We look at really at PEG ratios. We look at what the growth of this company versus the relative PEs of the market per se. So if you look at a company like NVIDIA, which is growing revenues at 50 or 60% and EPS at 100%, you actually justify to pay a little bit more for that stock, and that just kind of goes to all the other companies. But I think we have to, with this market, we have to look at companies that are actually generating some profits and some top line revenue and bottom line revenue.
I'll stick with you, Hatem. I know one stock that you've watched closely, as many investors have, has been Tesla. Those shares have been on fire recently, largely because the market is excited about Tesla's work with AI.
Absolutely. We've been early investors in Tesla. And I think Tesla is not looked at as an AI company, but if you look at the full self-driving software, and I know there is a lot of negativity around that, but if you look at the data that they've been gathering for the last 5 years or so, that they've been having the software in their cars, and how much of that has been used, and their efforts around this Dojo or this new AI computer they work in, I think Tesla is going to be one of the big winner in mobility in general as a result of that. So people should look at that.
Doug, we've got about 60 seconds left. Do you follow a couple of companies in this regard, known as Elastic and CrowdStrike?
Elastic is a vector search tool. Vector models are basically how every single LLM AI model is built. So Elastic is helping power and make those models more usable for the companies that create them. CrowdStrike is one that we are bullish on. We think that in the age of AI, the necessity of cybersecurity increases exponentially too, because the threats will increase exponentially. They'll be intelligent and powered by AI. Companies like CrowdStrike, we also own Palo Alto Networks. I think they are companies that can benefit from protecting us from the threats that may come from AI.